Hey, Tyler and everybody, welcome to our Mortgage Monday update. Hey, Tyler, what's going on?
Not much. How you doing for this Monday?
Good.
It's
So,
awesome.
give us an update. Where are rates today? Any big changes that you've noticed?
Yeah, I mean, right now the rates are hovering about 7.185. That's a 30-year fixed conventional financing. Last week we had the CPI number come out and it was a little higher. Inflation's still high, of course, so it didn't help as much. We did see a little calm down for this Monday, but guess what? The Feds are meeting this Wednesday, so that's always it's always a very um, agile day, So we get kind of
Right.
nervous to see what happens because you got the meeting and then you got the press conference. So just things they could say could spike the rate higher or lower. So
Right. Especially in this environment, it's like based on what words they use, it's up or down or up or down. And
exactly.
like
Yeah.
every week is just something different.
Yeah, it's just been a very volatile year this year, and I mean, I think personally, hopefully they'll pump the brakes on rate hikes this coming meeting, but we'll see.
Yeah, I hope so. So one of the things that you and
Mhm.
I talk about often are
Mhm.
rate buy downs. Are you still seeing that trend where people are doing like a 2-1 buy down? We've done that in the past together.
Yeah. Unfortunately, you know what? It's been really strange. You're not hearing too many people wanting to do it. We've been getting more of a permanent rate buy down request, and that's just again, it's less risk for the client. It's fixed for the next 30 years if they don't refinance. So we've been seeing more inquiries about the permanent rate buy down because I guess the 2-1 temporary buy down or the 3-1 3-2-1 temporary buy down. Again, it's a quick fix for a short period of time, and I think that's what people kind of like concerned about with the rates the way they are. There's just a lot of uncertainty, so they'd rather have the permanent rate buy down.
Right. And who knows what will be in 2 years, if there will be
Exactly.
any consistency at all. It's hard
Mhm.
to tell or hard to gauge just because this year has been the fastest increase in rate in 1 year,
Yeah.
right? So
It's
it's
so
I can
crazy.
understand why the consumer doesn't trust anything.
Yeah. You can't blame them. You can't blame them.
Yeah. Speaking of what the consumers are looking at, I was in a group yesterday. We were just talking about, what's going to happen and how everyone's talking about a crash. I mean, people have been talking about a crash since 2020, right? Everyone's
Yeah.
wanting this crash.
Yeah.
But in my opinion, it's like I don't think we're going to see a crash from people not being able to afford their mortgages. I think it's more so gonna be from something else,
Yeah.
but if we do have some sort of, US economic crash, I
Yeah.
don't think people are realizing what that means for themselves, like, they'll likely be out of a job, and they won't be able to
Exactly.
even if housing went down 50%, if they didn't have a job, they're not gonna be able to afford a house, so I
Yeah.
still get so confused why everybody wants this housing crash.
Yeah, I think the only thing I could think of is everybody's like, let's go to the recession already, right? And then they want to see the rates go down from the recession, right? Because when we have, I mean, if we anticipate a recession happening, that's when the rate's going to drop. But you're right, there's definitely effects to it, right? Personally, you might be out of a job. You're hearing a lot of layoffs right now. You're hearing about the auto industry having the strike right now. So I mean, those things definitely can affect the economy, and definitely can affect
Right.
your rates or whatever. So recession, it might be good in a way, but it's also, very bad at the same time.
Right. And from what you're hearing, right, in
Yeah.
terms of standards for underwriters, they're being really strict.
Yeah, it's been so insane. Like we've been seeing a lot of tightening with the credit, like with the underwriting and stuff like that. So what we're hearing, and just listening to our, reading our housing wire and all that good stuff, is the lenders are buying back a lot of loans or having to buy back a lot of loans. So now they're tightening up. They want to make sure that this is not going to happen again. So you can only imagine. I mean, everybody's going through a lot right now, but
Yeah.
definitely different from 2000, what 2005 to 2008 or whatever. We're not running to a situation for a recession due to the finance of the mortgages. Right now, it's like it's totally opposite. It's very tight, so very
Right.
tight in underwriting right now.
Right. It's almost like it's in the Fed's hands of what's
Mhm.
happening with pricing in general, because
Yeah,
we know that people with the low rates, they're not listing their homes for
yeah,
sale,
yeah,
and fewer buyers can qualify at the high rates that we're at today.
exactly.
Um, so the rate buy downs help us, temporarily, or they could help permanently. But
Yeah,
so there's some creative options, but
there is.
yeah, there's no imminent crash from what we can see
Hmm.
right now with how
Exactly.
strict they're being with underwriting and all of that.
Yeah, yep, exactly. And with inventory, we don't have enough inventory right now. There's still a big
Exactly.
shortage of inventory. So once the
Yep.
right homes goes on the market, it should be pending pretty fast. You know.
Absolutely. All right. Well, we will wait to see what the Feds say later this week. If it has an impact on the inflation numbers, if it has an impact on the economy in general, and hopefully we see some movement or at least a standstill on rates and no additional increases.
Fingers crossed.